Hello and welcome to Portfolio Matters. Thank you for your forbearance as we all disappear on summer holidays, and we'll be in and out over the course of August and early September. But in the meantime, Stuart Owen will read the disclaimer before we get going.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we may own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Great. Thank you, Stuart. Okay, first of all, news. So this is news over the past 2 weeks, and it's been an eventful couple of weeks. So first of all, the Fed raised rates by 75 basis points. Then the Bank of England raised rates by 0.5% to 1.75%. But what was really interesting was the Bank of England's comments. So they saw inflation rising to 13% later this year and warned that inflation was likely to stay elevated throughout 2023. They also warned that the UK was likely to go into a recession that lasted for 15 months and would involve a 2% peak to trough drop in GDP. Household incomes would fare even worse, dropping by 5% in real terms. Now, I think they are being optimistic about only a 2% drop in GDP. I can't see how you can get such a large drop in household incomes without very large drops in service sector activity.
Keith, just on that, sorry to cut in. I saw an absolutely terrifying chart over the week about the UK GDP profile, which was projecting what GDP would have been if we had continued on pre-2008 trajectory, which wasn't that great, was okay. And at the end of the BOE's GDP forecast, if even that optimistic number of only a 2% drop comes to pass, actual GDP will be 1/3 less than the pre-2008 trend. I mean, that's a huge drop in the wealth and the tax-paying capacity of the country. It's absolutely massive.
Yes, I saw that as well. Yeah, no, it is frightening. But I think going into this energy crisis, and we'll be covering the energy crisis in some depth, then I could see a great deal of stress for consumers and potentially, if you extrapolate that, a social and political crisis. I mean, we're already seeing parts of it in the form of consumer boycott of energy bills in the UK. And you could see that things could get really quite nasty in this coming winter. So the big news was that Russia, having restored Nord Stream capacity, promptly cut it back to around 20% of capacity. And that has prompted sharp spikes in European gas and electricity prices. We've got a special section on that coming up. And the EU, as part of its measures to negotiate the coming energy crisis, had agreed a 15% solidarity cut in energy use amongst its members. But immediately, Hungary broke ranks and has had separate negotiations with Russia to try and increase its own gas flows, which I think tells you all you need to know about European solidarity. And finally, Nancy Pelosi, the Speaker of the House of Representatives, visited Taiwan, and China took it very badly and are currently attempting to intimidate Taiwan, etc., etc. And when we talk about the Chinese housing sector later on, the Chinese economy is not doing very well. And one way, traditional way, that dictatorships distract attention from domestic woes is a bit of international interventionism and military action. So it could be a bad time to be a Taiwanese citizen. So a couple of charts. Well, These are Bank of England base rates, which have risen to 1.75%. But remember, year-on-year inflation in the UK is 9.4%. So real rates are an enormous minus 7.65%. And the markets are now pricing in a 2/3 chance that the Fed raises rates by 75 basis points at its next meeting in September. So one of the outcomes of the strong US jobs report, which we will cover, is that the Fed may have to raise rates harder than it would otherwise have had to. And finally, this is Russian gas flows to Europe. They've cut supplies through the Yamal pipeline entirely, and the other pipelines are all running at a fraction of capacity. So moving on to this week's economic data. In fact, this is the last 2 weeks' data, and there is a lot of it. So I will only cover the most important numbers. So first thing to say is that the US housing market appears to be slowing and slowing sharply. So the new home sales and pending home sales month on month both missed expectations and slowed sharply. And as we have covered many times before, the housing cycle is the business cycle. As the housing market slows, the economy will follow months later. So leading indicators turning down. Now, we then had the ISM manufacturing and non-manufacturing PMIs and surveys. And please pause and take a look. What is interesting is that the PMIs were resilient. In particular, the non-manufacturing PMI bounced hard. So it was expected to fall to 52.5. In fact, it rose sharply to 56.7. So the US economy appears to be quite resilient at the moment. The other thing I'd highlight is that the prices paid fell sharply, really sharply, both for manufacturers and for services. So in the case of manufacturers, the prices paid index was expected to fall from 78.5 to 76 in July, i.e. only slightly fall. In fact, it fell sharply to 60. In the non-manufacturing prices paid, it fell from 80.1 to 72.3. So input prices are falling sharply, and that could be good news for inflation. Now, we have a special section coming up on non-farm payrolls, but that was an enormous beat. So that was expected at 290,000 jobs created in July. It came in at 528,000. We have more details on that later. But the JOLTS job openings showed that job openings slowed. So in May, there were 11.3 million job openings. In June, that had fallen to 10.7 million, quite a large drop, and the quit rate also fell. We had Chinese Caixin PMIs, which showed that the manufacturing sector had slowed more than expected, but the services sector seemed quite resilient. All the European data was poor, frankly, which is unsurprising given the energy situation. European inflation was strong and rose for both core and CPI. We also had construction PMIs in Europe and the UK, and those were both weak and both showed contraction. Stuart, do you want to go through some charts?
Sure. Right, US new home sales. Here we can see a pretty substantial reversal of trend after the post-pandemic boom. These have come off very sharply, obviously a function of the big increase in US mortgage rates that we've seen this year. Pending home sales, very poor, minus 8.6 month on month. That's a very big percentage change for that time series. So again, the same story. ISM manufacturing PMI, as Keith said, actually not too bad. I'm still expanding. The level is above 50, though it's not half as strong as it has been in the post-pandemic bounce back. Prices paid, as Keith said, some initial signs here that perhaps inflation pressures are beginning to moderate, a big fall from 80 to 60. Manufacturing new orders, though, not looking very healthy at all, as now into contraction territory, having fallen from high 60s to a bit below 50 this year. ISM manufacturing employment, not too bad, at 50, sort of break-even level. Non-manufacturing PMIs, again, pretty respectable, coming in about 56, where 50 is the borderline between expansion and contraction. Not bad at all. Non-manufacturing, i.e. service business activity, pretty much the same picture, decent strength. Non-manufacturing new orders, again, decent strength, no evidence of immediate or imminent recession in that data series. Service employment, though, beginning to tail off here. I mean, this has been a big growth area, of course, but now the number is below 50, indicating no more boom time in service employment. The initial jobless claims, I think we can see a clear reversal of trend here, where previously it perhaps was just bottoming. Now it does appear to be in a reasonably pronounced uptrend. Continuing jobless claims, not quite so pronounced, but seemingly, well, it's definitely bottomed. How strongly this rises remains to be seen, given the latest, actually quite impressive employment report from the US. And here's the cause of the slowdown in the US housing sector. This is the US 30-year mortgage rate, which pretty much doubled from 3% to 6%, has come off a bit now, but is still 5.5%. So anyone with a house is just going to stick with it with their long-term mortgage. Anyone looking to move cannot afford to pay what they previously could. This is the small business optimism index, looking really rather sickly, having fallen. And this is obviously on a different scale. It's not centered on 50. Perhaps it's centered on 100 and is now down to 90. So not much optimism from US small businesses. EU industrial sentiment, well, I'm surprised this is as good as it is. It's a bit above zero. I thought this would be absolutely terrible, given the energy situation, but it's poor but not terrible at the moment.
I agree. I was surprised this is above zero.
Services, again, not half as bad as you might think. Nothing like the depths of the COVID crisis, but we've seen in other measures that Europe is in just as bad straits as then. But on this survey, it's not. Here we go. This is what we're more expecting to see. European consumer confidence has absolutely collapsed, given the news flow and the reality of energy bills. It's now worse than the great financial crisis, worse than the COVID crisis. Construction PMIs coming off very strongly in Europe. No one committing to building very much, given current conditions. This would be interesting to know how much of this was a demand and how much of this is supply chain problems. I suspect it's just as much the former as the latter now. UK construction PMI, similar picture, not quite so extreme, but it's come off quite a bit. Not too much enthusiasm in the UK construction sector.
Yes, and it's now below 50, Stuart, so indicating contraction. And on your point about supply chains, I think all the indications are that supply chain problems are now easing. So this is almost certainly demand, and higher rates obviously curtailing home construction.
EU CPI, my goodness, a few years ago we would have never believed this was possible, but approaching 9% on EU CPI, where previously there was some struggle to get it above 2%. EU core CPI at 4%, Again, the highest it's been in over 20 years. The China manufacturing PMIs, not as bad as I would have assumed, given all the news flow about the housing sector, which we'll come to, still a bit above 50. Services PMI bounced back very strongly, presumably a function of the slightly reduced zero COVID restrictions, but obviously therefore vulnerable to a reimposition of exactly those restrictions. The composite PMI for China, yeah, not too bad, just under 55. So overall expansion. Chinese consumer confidence, again, this is more what I was expecting to see. Absolute cliff face here, falling from 120 on this measurement, this index measurement, to below 90, so the worst in the whole time series, which seems to go back to about 1990. So again, I think it's difficult to believe this isn't anything but combination of COVID restrictions and the disastrous situation in the residential housing market. So in summary, the US housing market is slowing rapidly. And as Keith has covered on the show a few times, the housing cycle is the business cycle, and the housing cycle has very clearly turned. The ISM surveys show the US economy has actually remained resilient. There are a few actual signs of it currently slowing, and non-farm payrolls were extremely strong, beating all expectations. The China surveys showed that manufacturing activity has remained pretty solid, but there was that sharp slowdown in services. And the European economy is doing badly, particularly anything to do with the consumer, and construction activity is already shrinking.
Great, thank you, Stuart. For one chart this week, I thought this was very interesting and of real relevance to people who are currently working. So in the US, if you look at the wages of people who have switched job, they have managed to achieve real wage growth of 9.7% this year, which is really substantial, especially given CPI of over 9%. So you're talking about actual wage rises in excess of 18%. In contrast, workers who have stayed with their employers have seen real wage falls of 1.7%. So, if you are in employment, in order to maximize your earnings, you really have to switch employer on a regular basis. It would seem that the lesson is that the longer you stay with a company, the more they cease to value you, and you have to regularly move employer to get the recognition you deserve. Okay, and on to Inflation Watch, Stuart.
Yeah, so a pretty grim picture across the board, as we know. The new data from Europe showing CPI at 8.9% for July. They claim the core is just 4%. A quick reminder that there's still some QE going on in Europe. Germany should be pleased. Its inflation is now only 7.5%, having come down a little bit. Core CPI there, 3.2%. Now, here's another chart looking at Germany. Germany does appear to be approaching some form of a wage price spiral. So this is a chart showing German salaries and wage growth, nominal, year over year, which has now reached 7.4%, the highest since the early 1990s. And given the way that some parts of the German economy negotiate wages, i.e. via collective bargaining, this is possibly a sign of that wage price spiral in action.
Yeah, the problem with the EU is that it really can't raise rates because of the problems it would cause the periphery. So his monetary policy is just stuck around zero and completely inappropriate for a currency area which has inflation running at around 9%.
Yes, I mean we've covered this before, haven't we? The EU is the euro is an incomplete union, and the inherent tensions are beginning to play themselves out. Here's an interesting chart. looking at the world inflation rate and a measure of supply side price increases. Now, that measure is a composite of various PMI measures. Now, this is gently encouraging because in the sort of grey line, we can see world headline inflation approaching 7.8%. However, the price pressures from the PMI components act as a bit of a leading indicator, and they're shown in the red line. And they've been coming off pretty sharply over the past couple of months. So this is some encouraging forward-looking data suggesting the worst of the inflationary pressures may be passing us by, at least at the global level. So in summary, supply-side pricing pressures do appear to have peaked. Demand-side pressures from wages in particular are rising. So central banks are looking to have to raise interest rates further to contain the inflationary pressures, and yet they're doing that in the face of an imminent recession.
Yes. Okay, and on that note, recession watch. And I note that there is far more discussion about recession these days than there is about inflation. So inflation seems to be falling off investors' radar screens, and people are increasingly concerned about recession. So global PMIs are negative now and falling. So the world, the leading indicators show that the world as a whole is likely to start falling into recession in the coming year. In the US, the Empire State Manufacturing New Orders Index is crashing. Now, this is the New York region, I believe, and that is not good. The New Orders Index is at lows last seen during the Great Financial Crisis. The yield curve is once again forecasting a recession, and this time the inversion is getting steadily worse and is large. So the bond market is increasingly confident of its forecast of an imminent recession in the US within the next 18 months, I should say. Now, US real wages have now been negative for 15 consecutive months. And if you look at the bottom half of the chart, you'll see that real wages are now below where they were pre-pandemic, although nominal wages are up by 12.3%. That just shows you the effect of inflation.
Keith, so from a macro perspective, we can sort of summarize and simplify and say there are more people employed, but they're not being paid so well. So from a macro point of view, you could say the demand remains there. It's just that for an individual, it's a more miserable situation.
Yes, that's right. So nominal GDP is doing very well, but real GDP is not doing so well. And there's been quite a lot of debate about whether you can have a recession, because the US has now reported 2 quarters of negative real GDP growth, which is traditional measure of recession, while nominal GDP growth in the US has remained very strong because of inflation. But to my mind, this is, the classic problems of emerging markets. I mean, if you look at Venezuela, its GDP growth in nominal terms is absolutely enormous. If you have inflation running at 70%, then its nominal GDP growth is 65, but the economy is continually slowing in real terms. And if we look at new orders minus inventories in the US, then not encouraging. Inventories are rising, new orders are falling. And reminder, building inventories tends to exacerbate the downturn in manufacturing orders, because as retailers find they have excess inventory, they cut their orders. And moving on to new homes, well, this is the sale price for new houses sold in the US, and that is quite a drop. It is, having been rising very quickly over the last year, suddenly it has turned sharply downwards in the last couple of months. And total new home sales, so the number of transactions, has fallen by 43% from its recent peak. So we are seeing a rapid slowdown in the US housing market. It is an inevitable result of the fall in the affordability index. What you've seen is rising US house prices. US house prices have been rising at over 20% a year, and interest rates have doubled, leading to a big deterioration in affordability. And Bank of America is reporting that there's been a 29% fall in mortgage originations. This chart just summarizes that both home sales and house prices are now falling in the US. I thought this was very interesting. So, when you look at the construction market in the US, almost all of the recent construction boom has been in residential property. Non-residential has been flat for many years now. And so it's as though in order to get the economy going, you have to continually keep blowing bubbles into the residential property market. And I think the current bubble is now bursting. Delinquency rates for various types of loan in the US are very low by historic standards, but are rising. Figures to the end of Q1. In the UK, corporate insolvencies are rising strongly. Now, it may well be that the pandemic support packages from the government kept alive a lot of zombie companies, which are now rolling over. But this is not a good trend going into an energy crisis. However, US economic surprises have actually been positive over the last month, and that is not what you would expect to see in an economy that's about to go into recession. So there are various signs, including the recent PMIs we have reported, that's showing that the US economy for now remains resilient. And if you look at the main indicators that the NBER, the National Bureau of Economic Research in the US, uses to declare a recession, well, these are the top four. And for a recession to be declared, they would have to be negative, and they're not. So we're not yet in a recession in the US, despite the fact we've had 2 quarters of negative GDP growth. In summary, the US housing market is slowing sharply, and that is a strong leading indicator, which would suggest within the next 18 months, the US economy will go into recession. The US yield curve is also inverted. Global PMIs are falling, but right now, the US actually seems to be okay. And the US is best placed to weather the coming economic and energy crisis, which will really badly affect Europe. And on to the energy crisis. 2 weeks ago, we were awaiting the resumption of gas flows through Nord Stream. Now, Russia has resumed gas flows, but then promptly cut them back to levels which will cause Europe a big energy crisis. We've seen spikes in electricity and gas prices. Now, as a result of Russia cutting back its supplies, Norway is currently Europe's biggest gas provider.
And Keith, I assume Norway can do no more. They're at maximum capacity, I guess.
Yes, absolutely. So these are European gas prices, and the grey bars at the bottom are the historic range. And you'll see that 2 things. First of all, current gas prices are way above where they would be normally. And B, that gas prices traditionally rise into the winter period. And if gas prices are high now, they're likely to get much worse in the coming months.
Keith, well, one small little um, opportunity, if you wanted to call it that, is in some of the green energy stocks that I've occasionally highlighted on the program, because they operate wind farms and solar panel farms, and they take the electricity price, which is often, of course, set by the gas price. Now, many of them have been hedging forward into these rising prices, but some of them don't have a hedging program and just take the spot price. And so they've been, making money hand over fist. The risk, of course, is that there's some form of windfall tax, but for the moment, they're actually straight beneficiaries of this. So these are companies like Greencoat UK Wind, which I think offers about a 5% yield, growing by RPI, not even CPI, every year. So that's one minor hedge that people might want to think about. Obviously, always a risk of retrospective legislation.
Right. So, Stuart, if it's yielding RPI plus 5%, then where's the upside? How do you benefit from the upside?
Well, 5% dividend growing by RPI is quite attractive to me. So,
it is, but if we've seen that energy prices have quadrupled, then how do you benefit from the quadrupling?
Well, you're more harvesting as the energy is sold each day, each week. The accountants try to measure what this does for the net asset value of the company by gradually upping their forecasts for future energy prices. But of course, their forecasts tend to be lagged averages of where the energy price has been. So if the energy prices are higher than the forward curves have been expecting, then there'll be big increases to the NAVs of these trusts.
Right.
Now, quite often the trusts take a very conservative approach to the asset values, where, for instance, one which reported last week is only assuming 3% inflation next year because it wants to be conservative. But if it comes in at 10, then you've got another 7% uplift in the RPI-linked subsidies that form half of the revenues of these businesses. So, if there wasn't any risk of retrospective legislation, I mean, these things are one of the few hidey holes where you can really, protect the real value of your investment.
Very good, very interesting. Thanks. So, returning to the energy crisis in Europe, well, this is German baseload power prices. And this is the price for December 2022. And if you look back to where it was at the start of last year, you're talking an 8-fold increase. And this is French 1-year forward electricity prices.
This one reminds me of O-level maths and some sort of asymptotic equation or something like that. It's phenomenal, isn't it?
Absolutely. And this is where we are. If you look at the futures curve, then where we are now, prices are expected to double again by December. And bear in mind that in the lows in 2020, you're talking about 20 euros per megawatt hour. And now the prices for December are forecast to be over 1,000. Another problem we're having, what's exacerbating the current high energy prices in Europe, is the drought. And so 75% of Germany's hard coal imports come up the river by barge. And the drought is causing the water levels in the Rhine to fall. And you see the water levels, the white line, are now the lowest they've been since the last drought in 2018. And as the water levels fall, and they are forecast to continue falling for the next 2 weeks, so the barges can only carry lighter loads. So they have to reduce their draft by carrying lower tonnage. And that means price per ton is rising. You see, These are the barge rates to Basel in Switzerland. And they are approaching the peak levels they saw during the last drought. In addition, low river levels are bad for French nuclear power stations. So the cooling water that comes out of a nuclear power station is obviously quite hot. And the regulator restricts the amount of hot water the nuclear power stations can pump into the rivers. Now, it has relaxed those rules over the course of the last month because of the drought, but we're now reaching levels where nuclear power output will have to be curtailed. And actually, France has been having problems with its nuclear fleet. And if you look at the number of days per year when it's had to import electricity, there's been a clear upward trend. So all that means is that we keep on talking about the power problems in Germany. Well, actually, baseload power prices are highest in France and by quite a long way. And the UK is not doing very well either. So moving on to gas, well, gas storage levels in Germany are below where they should be for this time of year and below target. Now, bear in mind that the normal gas levels get Germany through the winter if it receives normal levels of gas flows from Russia. Now, this year, there won't be normal levels of gas flow from Russia, so it should have far higher levels of gas storage than normal in order to see it through winter. It doesn't have those, so a crisis is coming. And this is the futures curve for European natural gas contracts. And essentially, the market is not expecting normal gas prices to return until 2025-26. So be prepared for a prolonged period of elevated gas prices. And high gas prices, high energy prices are going to have a chilling effect on European manufacturing of all kinds and European basic industries such as fertilizer manufacture. And you can see here, German car manufacturing has collapsed. Now, part of that is supply chains, but the supply chain problems are easing. Right now, we talk about this, but the reality is it hasn't really hit most consumers. In the UK, the price cap doesn't rise until October. And in Germany, Rhine Energy has just announced that its price for natural gas for German consumers will rise by 133% in October. And so I'm expecting this to remain a fairly theoretical problem for most people until the bills start to arrive. And then we'll have a proper crisis. Stuart, your thoughts?
Well, it's difficult to be anything other than sort of, pessimistic, isn't it? These are sort of super tanker-sized problems heading towards, the rocky cliffs, and there's not much that can seemingly be done. I mean, the lack of LNG import facilities is not something you can, wave a wand at. It's going to take a couple of years for Germany to build those. Meanwhile, I think it's going to be another pressure for European fragmentation, with different countries having different susceptibility to these sort of problems. I mean, compare Spain with France, France with Germany. It's going to be difficult, I think, to get some sort of, what did they call it, a solidarity reduction in energy consumption. I think it's going to be a real focus and force for fragmentation.
I agree. And over the past couple of weeks, we have seen a bounce in both sterling and the euro as some risk appetite has returned. And I just remain very cautious about both currencies. I think a big energy crisis is coming, and that will morph into a social, political, and financial crisis quite quickly. And as you talk about the Eurozone cohesion, you can easily see that centrifugal forces in the Eurozone cause a return of the Eurozone crisis and fundamental questions about the viability of the currency. So moving on to the US jobs report, Stuart.
Well, this is a bit more jolly, a bit more optimistic. Let's have a look at the data. So monthly jobs growth was up 528,000, which was massively beating expectations. As Keith pointed out before, a lot of this was part-time workers, though. But technically, the unemployment rate is now just 3.5%, and average hourly pay is up 5.2%. Obviously, though, in the context of inflation, which is quite a few percentage points higher than that. Now, this chart I thought initially was showing the same information twice, but it is actually slightly different. The red line is the employment to population ratio, looking at 25 to 54-year-olds, and we can see that that has bounced from a COVID low of just 70% up to 80%, which is just a little bit lower than the pre-COVID ratio. The blue line is the participation rate of 25 to 54-year-olds, which is actually technically slightly different from the employment to population ratio, because the participation rate looks at people who are either in the workforce or who want to be in the workforce. And that also has bounced back to almost the pre-COVID levels. But the gap between the line, in a sense, is people who want to have a job but don't have one. So that can be an interesting statistic in itself. So 330,000 of those 528,000 were part-time jobs, however. So you can query the quality of the jobs, but 500,000 jobs in a month is not bad. And although so many of the forward-looking indicators look poor, the current reality is that there are jobs for anyone who wants them. Long-term unemployment is now just below its pre-pandemic level, and so the Fed in normal times would be saying, that this is a sign of overheating and would be looking to raise rates, which of course they are, but for slightly different reasons. This chart looks at the speed with which job losses have been recovered in previous recessions. So the blue line, for instance, is the 2007 employment recession, which took a long time to unwind. The 2020 employment recession, i.e. the COVID recession, was much sharper, of course, but then has bounced back very quickly, a very different type of job recession. Total US job openings are now beginning to fall, however. So perhaps we've seen a peak in the growth in the US jobs market. So for the past, 4 or 5 months, it's been coming off its high. That is the total job openings. A quick reminder, jobs, however, are a lagging indicator. And Keith's pulled up a chart here from the 70s showing that it's quite consistent to believe in a recession, but also to observe an increase in non-farm payrolls. It's a lagging indicator. So we can't use it as proof that a recession is not imminent in the US.
Yeah, I found this really interesting, actually, because this was a really bad recession caused by the Arab oil embargo. And yet the economy continued to create jobs for the best part of a year before a very sharp slowdown. So sharp drop in payrolls. But, it's a big lagging indicator. And if you look at all the recessions in the 1970s, then they were all characterized by strong initial job growth. So,
I wonder if this is, company X wants to recruit for a certain position, doesn't quite believe or isn't paying total attention to economic data, and continues with the recruitment that they individually need. It's a sort of there's momentum to the job creation process where it just takes a while. You've placed the advert, you're getting in the people to interview, and you're making your decision. So you're sort of pre-committed to the job.
Yes, that's very true.
So in conclusion, a very strong jobs report, though there are some caveats. A lot of the jobs were temporary, and those temporary jobs, of course, in the US don't have the same social security protections, in particular healthcare, that a full-time job has. And job openings appear to have peaked and are declining. So in a relative sense, this is good for the dollar because the US appears to be the cleanest dirty shirt when it comes to the economic and, in particular, energy outlook.
Okay, thanks, Stuart. Now, on to the Chinese mortgage boycott. Now, we covered that this in brief a few weeks ago, but it's ongoing, and this is a great chart from the FT showing that there's been a real slowdown in the Chinese residential construction sector. And as we've talked about with relationship to the US, the housing cycle is the business cycle. And if this continues, you'd expect a sharp recession in China. And what marks China out from the rest of the world is it has a relatively undeveloped financial sector, which private citizens have trouble accessing. And so the majority of their wealth is held in housing. So a fall in the price of housing will have a real effect on household wealth, and the wealth effect would then tend to cause consumers to cut back on spending. So you could see a strong recession induced by falling house prices.
Keith, I don't know if you're aware of any data on sort of price to earnings ratios for Chinese housing. I dimly remember reading it's about sort of 15 times average earnings.
Yeah.
And even in the UK housing bubble, I think we're about 9 or something. So it gives some sense of, the degree of overvaluation that there might be.
Yes, absolutely, Stuart. The numbers are really high. And a lot of houses are held essentially as wealth products and not lived in. And so there's always a question in China about how long you could support a housing market which mainly consisted of empty flats held for investment purposes. I mean, how many empty flats does a person need? So this is a map showing where all the unfinished property projects are that Chinese house buyers are currently boycotting. Reminder, the way it works in China is that these new builds, the consumer, the home buyer, pays upfront a deposit, then continues to pay the mortgage while the house is being constructed. And what's happened is that all these house buyers have paid the deposit and are paying the mortgage, and construction has stopped. So in frustration, they have stopped paying the mortgage, which means that the construction company then doesn't have the money to complete the construction, leading to a vicious circle. And all of this means that construction activity in China is slowing. And if there is a property crisis in China, well, the banks are fully exposed to the property sector, having been essentially ordered by the government to provide loans to developers. And so a property crash will very quickly morph into a financial crisis. And we've seen that in Henan province, where the consumers have been trying to get their money out of a bank and have been essentially unable to do so as the local government set the thugs on. But so far, all the credit stress has been seen in the offshore bonds rather than onshore bonds, so in dollar bonds. Now, the government is going to try and address this, and the FT had an article talking about how the People's Bank of China was attempting to get commercial banks to lend a further 1 trillion renminbi to property companies to bail them out, to allow them to finish construction. But the banks are already very heavily exposed to all these losing property projects. And is this going to work? Estimates are that they will need far more money than the PBOC is currently talking about. Sorry, Stuart, do you have any ideas, any thoughts?
Well, I think every emerging market goes through this sort of property bubble, but in China, of course, it's always at 100 times the scale of anywhere else. That this looks like a story we've seen before. When the difference, of course, is the Chinese Communist Party might just have a fire hose of money to soften the blow, to cover it over. We could see debts being delay and pretend, which we've seen in other countries, but on a massive scale. I don't think they can afford an economic crisis, and they will create the money to paper over the cracks.
Well, I mean, yes, you're absolutely right. This does remind me very much of the Japanese property bubble. And when you think about the remedies available to the Chinese government, well, yes, they could pump the commercial banks full of cash and get them to lend to the property developers to finish construction. But as we talked about earlier, if these house prices are 15 times salary and ridiculously overvalued, then the moment people start to become skeptical about the potential for further house price rises, then there's no reason to buy more property. In fact, people then try to start to sell the property, and these prices just become unsupportable financial crisis. So unless they can prop house prices up indefinitely, they're just delaying a crisis.
Yes, that's a very good point. And I suppose when these have been built out and the immediate borrowers, at least given their flat, that you're never going to have the construction on the same scale again. And I think we've covered in previous episodes, is it residential construction is about 25-30% of GDP. And
Yeah.
if it's never going to rise to the previous level, that's a big gap to be papering over.
So in summary, the Chinese government has a very good history of kicking the can down the road. Will they manage to do it this time? We'll just have to wait and see. Okay, on to food prices. Stuart.
Yes, well, this is a quite optimistic segment, isn't it, Keith? Here we go. Here's some data. We've obviously been concerned, but that food price rises would cause social dislocation and possibly chaos, particularly in poorer parts of the world. Obviously exacerbated by the difficulty of getting grain out of Ukraine and Russia. But here's the latest data from the FAO looking at their food price index, which has fallen from 160 to about 140. So it's still elevated, but it's not quite the crisis that it was looking initially. And in more detail, that fall is coming from vegetable oils and cereals. Dairy, however, continues to be rising. Meat never really took part in the big expansion. It was really the big expansion of prices. It was really about cereals and vegetable oils and dairy, all of which are beginning to come off quite strongly in the case of vegetable oil. And here's the wheat price, which now looks to be at exactly the level that it was prior to Russia's invasion of Ukraine, at $775 a bushel. Soybeans, again, given the context of the normal volatility in commodity prices and softs, it's not actually moved very much. It rose a little bit in the early part of the year from $1,400 a bushel up to $1,700, then came off to below $1,500, is now at $1,600. So to some extent, nothing to see here.
Yeah, and particularly when you think that inflation's running at 9%. So, left to its own devices, it would have risen 9% anyway.
Good point. Here's palm oil, which is now below the level that it was trading at the beginning of the year. Corn, a similar pattern to wheat. Canola, otherwise known as rapeseed oil, Canadian dollars a ton, has fallen from a peak of 1,200 to now 850. The main fall seemed to happen really in June, but these are very big price falls. Rice has got a rather different pattern after trending up for the most part over the autumn and the winter. Had a brief period of weakness coming into July, but now looks pretty steady. But the point here, I think, is just that it didn't have any of the massive moves that we saw in wheat and corn. Presumably,
Yeah.
Ukraine doesn't grow too much rice.
Yeah, and what's happening is that climate change is causing obviously heat waves everywhere, but in particular, Bangladesh and India are suffering from a drought. So the rice yield's quite poor. Now,
So,
I'm really surprised by this, Stuart. I don't know what your thoughts are, but the given the disruptions to Ukraine and Russian wheat exports and the very high fertilizer prices, I'm just absolutely astonished that how food prices have come down as much as they have. I mean, to me, that would mean, to me, the best explanation is that the market is expecting some sort of demand destruction.
the only other thing I could add to that, and I think it's a fairly minor point, but a lot of those charts were in dollars. So perhaps in other currencies, in local currencies, it's still painful if you're Egyptian or Indonesian or
Yeah,
something.
yeah, absolutely. But the ability of markets to surprise
Hmm.
is undiminished. Finally, other charts. Well, we are in the summer doldrums, low liquidity, volatility rising, but then it really gets going in Q3, Q4. So
But
be warned.
Keith, is this the volatility of volatility or volatility?
Um, Actually, you're right. It's the volatility of volatility. Yes, you're right. I thought this was great. So this is the price of real estate in the metaverse.
But
And
Keith, you're using the wrong measurement here. You should be
yeah,
pricing this all in Luna or
well,
Ether or something.
yes, well, in real money or, the unit of account that we use, US dollars, then they've collapsed by over two-thirds in 6 months.
So I can't hang my NFT on my virtual wall in my virtual piece of land.
Well, you can, Stuart. It's just got a lot cheaper.
Ah.
Just buy two.
So our weekly checklist, turning firstly to equity markets. This is the performance over the past couple of weeks. The all share up 2%, Europe up 2.5%, the US up 3.7% as measured by the S&P 500. The tech stocks in the Nasdaq up 5%. The Hang Seng being the one main outlier, down 2%. Japan basically flat, off 0.5% over the past fortnight. Bitcoin bizarrely quiet, change of only 0.2%. Something wrong there. The pound has bounced back a little against the dollar, up 1.2%, and the dollar more generally giving back some of this year's very strong gains. The dollar index there, 106.6. Here's a chart of the S&P 500. After the end of quarter gnashing of teeth, it's bounced back pretty strongly, now 4,145.
Oh, yes, we talked about this a few weeks ago. The sentiment index was really, really negative. And we said that it looked like sentiment was too negative and markets were due a bounce, and they have bounced strongly. And I think this is very much a bear market rally. What do you think, Stuart?
I think that you think that. I think that I don't know. But one thing I do want to say is that there was a great quote a couple of weeks ago. I think some fund manager said, "I'm so bearish, I'm bullish," which because everyone was so negative, it had fallen so much that it had to bounce, and indeed it has done. Now, I do know what you mean. If I had to bet, everything just looks still richly priced, and the momentum is going out of earnings revisions and out of the economy. But from my investment perspective, I just know I've been so wrong so often on making big macro calls that I haven't been able to join you and Richard in, the big cyclical decision to go to cash. The Nasdaq, a very strong bounce there as well. I'd love to redo some valuation ratios on that. We had a look a couple of months ago, and I think the best number that I could get to when I saw even roughly fair value was about 9,000 on the index. It's now 12,700. So to me, it would still seem very richly priced. Now, this chart, I'm not totally sure of the data here because it's a comparison of the P ratio and the earnings forecasts. And the point is that the S&P 500 hasn't been rising due to increases in earnings forecasts, but increases in the PE. Having said that, the PE is supposed to be the blue line, but it's coming in at 114.6. So there's something weird going on with that.
So I know it's the problem is, Stuart, that it's normalized to 100 in June.
Oh, I see. So the PE has gone up by 14.6%.
Yes.
Okay. Got it. But I think the main point here is the orange line with the earnings forecasts having been chipped away over the past couple of months. Another way of looking at those earnings forecasts is shown here. The white line is the S&P 500 earnings forecast X energy, which is showing a pretty remorseless reduction in growth expectations. Still growth expectations, but coming off rapidly. But if you include the energy companies, then the overall aggregate level is still not too bad at all at about 9% earnings growth. Trying to get a handle on valuation, here is the MSCI World Index PE ratio, which has bounced to, what's that look like, about 26, peaking over 30 on the upside, and during the GFC, bottoming at something more like 11 or 12. So still very much in the upper percentiles of the data series of the PE ratio. So S&P report earnings growth is now 3% year on year in terms of reported earnings. That's after 75% of companies reporting their Q2 earnings. So some evidence of shrinkage compared to last year. Keith, I wondered if you wanted to do this one. This rather fun chart.
Well, this is the Investopedia checklist to check whether the current bounce in markets is a bear market rally or the start of something more sustainable. And I leave it to viewers to go through and tick off how many of them indicate that we've reached a market bottom. To me, pretty much none of them. So I think this is a bear market rally, essentially. And I would be very wary of buying equities into it, given we're just about to go into an energy crisis in Europe and the traditional Q3, Q4 market crash period. So moving on to energy commodities. Oil prices had a bad couple of weeks as the markets become increasingly concerned about a global recession and demand destruction. Dutch natural gas futures rose 21% over the last couple of weeks as Russia cut its supplies to Europe. British natural gas futures rose 18%. Now, I should say that we've added British natural gas futures in response to a request from our Discord member, JB. Thank you for that. I should also add that, sadly, the numbers between the different natural gas futures are not comparable because they're on a different basis. So Dutch natural gas futures are reported as euros per megawatt hour, British as pounds per therm, and US natural gas futures are dollars per million British thermal units. US natural gas futures rose only 2%. Coal futures fell by 10% as the market is apparently concerned about rising supply, although it is up 113% year to date. Uranium rose by 3.7%. Some numbers relevant to the oil market. Well, over the last couple of weeks, total inventories in the US, including the Strategic Petroleum Reserve, fell by 10 million barrels. Although the private inventories rose by 223 barrels, i.e. they were flat. So in summary, releases from the Strategic Petroleum Reserve are fully supplying US private markets, but obviously that is unsustainable. At some stage, you run out of oil in the Strategic Petroleum Reserve, at which point oil prices might rise very sharply indeed. US
Keith,
oil...
sorry, Keith. I heard an interesting suggestion on an investment podcast where the presenter was talking about the possibility that the US government should be, okay, if they're selling from the Strategic Petroleum Reserve, they could be buying, the futures 1 year, 2 year, 3 years out. Partly, of course, because they want to replenish the SPR, but the argument was more subtle. He was making the case that if you did that and you supported the futures price, that is actually what will encourage investment in resources if you want to generate more, production, because people are not going to make their investment decisions based on the spot price. But if you had a firmer futures price, that might encourage the production that you want.
Yes, absolutely. And that's exactly what they've been saying. They're saying that they would commit to buy to replace the barrels they have sold from the SPR by buying them a year forward or 6 months forward. And the market is currently tight. It's in backwardation. So actually, they'd make a decent profit selling expensive current barrels and buying cheap forward barrels. But they've talked about doing it. They ain't actually doing it. And they've talked about doing it after the midterms. So, let's see whether they actually do it. US total crude production rose by 200,000 barrels over the last couple of weeks, and that is back to its highest for a year. But essentially, the swing producer, the US, has hardly increased production at all this year in response to very elevated oil prices. And if you look at the Baker Hughes rig count, it actually fell by 1 last week. So, they're not going back to work. So this is crude oil charts. It's had a bad couple of weeks. And now this is US gasoline supplied according to the EIA. And you'll see that it's really quite weak. It is well down on last year and falling. Now, HFI Research are skeptical about the numbers from the EIA because this is about 8 or 9% down on normal, which indicates that there's been very significant demand destruction in the US. If we look at total crude production, we are well below our peak in 2018. And in order to get back there, we need to discover some more oil fields and invest in a lot of capex, which we are not doing. I'll show you a chart in a minute. Returning to the US, this is EIA total liquids excluding the SPR, and you'll see that it's stable. But if you include the SPR, then drawing down. So US private markets are being supplied only because we were drawing down from the Strategic Petroleum Reserve. But if you look at products, quite stable. Global oil inventories still falling. So I don't quite understand why oil prices have had such a bad couple of weeks when global inventories are still falling. It means the market must be very pessimistic about the future. Skip that. And returning to discussions about capex, well, here you see the black line is capex as a percentage of revenues, and it's just collapsing. So energy companies are not reinvesting their earnings into new wells. And if you look at the absolute investment, which is the blue line, it remains well below pre-pandemic levels despite very high oil prices. These Dutch natural gas futures, which are high, but as we discussed earlier, likely to keep on rising. British ones, US, coal, having had an amazing run, came off very sharply last week. And uranium is stable. Industrial commodities, Stuart.
Right, well, here we go. Some broad weakness, I think, reflecting the fears of recession. So aluminium down about 1% on the week, cobalt off about 2%, copper having had a bit of a bounce, but that has to be put in the context of some quite pronounced weakness over the past few months. Chromium off 2%, iron ore up 11%, lithium carbonate basically flat on the week, though up 72% for the year. Neodymium off 7% for the week. Nickel bounced there, up 3.4%. Tin, largely unchanged, off about 2%. Ferrovanadium off 4%. And the big mover of the week was zinc, up 17%. And looking at that in charts, well, the movement in aluminium is dwarfed by the recent movement is dwarfed by the change over the past few months, where it's fallen from $3,750 a ton to more like 2,400. But seemingly that the fall, actually, hold on, I'm treading on Richard's toes. I'm about to make a chartist comment. So to me, that looks like the fall has bottomed out and it's just trundling along. Is that a technical term?
Well, yeah. I'm skeptical about this, Stuart, because the thing is, there are two things going on. Is that aluminium price surely must be supported by the cost of energy, because aluminium is like coagulated electricity. So as the electricity price goes through the roof, wouldn't you expect the aluminium price to keep on rising? And that must mean that demand has absolutely collapsed.
Cobalt, a very strange chart in some respects, very sort of doesn't move much and then moves a lot. We've now fallen from $80,000 a ton to just under $50,000 a ton.
Yeah, in all these industrial commodities, it's been an astonishing year. The first quarter, you see rises about 30%, and then it's collapsed in the Q2 as the world economy is perceived to be slowing.
Keith, I think we should do a review episode where we look at all the brokers' notes in the first few months of the year, talking about the strategic long-term case for commodities, supply shortages, and real assets. And then we should look at the subsequent performance.
Yeah, super cycle.
Yeah. Copper, now this is the interesting one, given its long-term need in the green energy transition, bounced over the past few weeks from $3.25 a pound up to $3.55, but in general has been pretty weak since May. And I think we've used this phrase before, but Dr. Copper is forecasting a recession.
Yeah, and if the US housing market is slowing, construction market slowing, then you can see prolonged weakness for copper.
Chromium coming off a little bit recently, anyhow. Iron ore. Well, I suppose Richard would say that are you in a downward trend here? You're in between various lower highs and lower lows.
A channel, I think, is the chartist term. So right. It's had a big bounce from its lows of 100, but drifting off again.
Lithium. There's not too much volatility in the volatility of this one. Pretty flat. Neodymium, what's that used in, Keith? Because that's come off a reasonably large percentage as well, hasn't it? About, 15% in the past few weeks?
No, neodymium is mainly used in magnets. Yes, very strong magnets. So neodymium magnets are much stronger than iron magnets. And a big wind turbine can have up to a ton of neodymium in the motor, in the turbine. So you'll see that as we've gone through these, a lot of the new technology elements have retained their value better than the industrial ones, and neodymium is one of those.
Nickel, not too much move, certainly in the context of the history that it's had this year with all the troubles at the LME. I'm very interested to see how those legal cases shake out over the next few years. It'll be slow and painful for every participant, but quite entertaining for us. Tin has taken a few steps down this year, particularly since March. Seems to have some sort of bottom at about $2,450 a ton. Ferrovanadium, after an enormous boom, has petered off and not too much happening recently there. Zinc, however, has bounced back quite a bit. I don't know any particular story for that, but has risen from $3,000 to more like $3,500 a ton. Precious metals, you sure there's some mistake here, Keith? It looks like gold has gone up a bit over the past couple of weeks. That's not what we're used to reporting. It's been a big disappointment. So up 3.5% over the past fortnight, down just 3% for the year now. Silver, a more high beta version of that, up 6% for the past fortnight, off 14% for the year. Platinum up 6% over the fortnight. Rhodium off 4%. Palladium, a pretty big bounce there, up 12%. So here's chart of gold. So gold appears to have bounced alongside the Nasdaq, therefore reinforcing its role as what? A risk currency.
Because it's priced in US dollars, as you pointed out, in other currencies such as sterling, it's done all right. But still not great, given that sterling is suffering a lot of inflation and is declining in real terms. So.
Silver looking pretty sickly. It's bounced over the past few weeks, but that looks pretty ugly chart to me. Platinum, however, bouncing back towards the bottom of a previous range, looking more like, it's now over $900 an ounce. Rhodium, not too much to say, floating along, not too much activity over the past few weeks. Palladium, again, some strength, but nothing too dramatic.
Okay, thanks, Stuart. Right, on to rates. Well, so we've had, in the last couple of weeks, we've had UK raising rates by 50 basis points to 1.75%, and the US raising rates by 75 basis points to a range between 2.25 and 2.5%. And all of that has meant that the last couple of weeks we have had a small rise in the short end of the yield curve. In the UK, the 2 years risen by 7 basis points, the 5 year by 14 basis points. But what is really interesting is the long end has not risen. It's actually fallen. So the market is now beginning to price in a recession and seeing further tightening at the short end as likely to lead to further falls in inflation in the long end in subsequent years. Now, what's really interesting is if we look at the Eurozone periphery, yields have really come down. So Christine Lagarde has managed to successfully talk down the Greek and Italian bond yields. Although is not just talk. What she's done is she's been selling German and Dutch bonds and using the proceeds to buy Spanish and Italian bonds. Now, I hear that there are plans to challenge the legality of this in court, but we will see.
I was so surprised. I laughed out loud when I saw this because whenever you hear about these anti-fragmentation devices, the immediate thought is, oh yes, well of course, we've got to buy Italian bonds, Portuguese bonds, whatever. But of course, you can reduce the gap by by selling German and Dutch bonds.
Yes.
Yeah.
Yeah. I said the whole idea that in the articles of the Eurozone, you're not meant to have fiscal transfers. But, this is just disguised fiscal transfer.
Well, every time there's a crisis, the previous rules that you thought were in place are bent, are twisted. Legalese is used to get what is politically necessary. It's very difficult to have long-term faith in the supposed guidelines and guardrails that were put into place.
I thought this is really frightening. So essentially, this is who has been buying Italian bonds. And the blue line is the national bank, i.e., the ECB, via the Banco d'Italia. And foreigners have been net sellers, as has everyone else. So if you look at it in total over the last few years, essentially, the Italian fiscal deficit has been entirely financed by the ECB. Amazing. And how long can that be sustained? Well, this is German 10-year, which, given the ECB selling the bonds, the yield's rising. Whereas over the past 2 weeks, the yield on the Italian 10-year has fallen sharply, as has the Greek 10-year. So the plan is working. This is UK 10-year and US 10-year, both of which rose during the week, particularly after non-farm payrolls. Reminder, the seasonality chart is saying that later in August we'll have a bull blip before we go into September and October, which is always exciting. Okay, Stuart, what have you been up to this week?
Well, I have to zoom out from that, Keith. 1 week is not really the right time horizon for me. Over the past few months since I was last on the show, let's focus on that. So year-to-date performance, I'm now up 1.1%. When I came on previously, I was down a bit, and this recent rally has lifted me. As ever, there's a trickle of income. My aggregate portfolio yield is a bit under 4%. I'm remaining a lot more fully invested than Keith and Richard. For me, it's time in the market rather than timing the market. But I don't know quite whether to think this is a wise adherence to my long-term strategy, or am I a rabbit in the headlights, sort of unwilling to make the big decisions needed? So I'm trundling along. In terms of actual activity, I had another realization from an enterprise investment scheme, which we've covered occasionally in the past. This was run by Seneca Partners, and this was some storage units which they refurbished and operated as a business, and that made about 30% in addition to the various tax benefits. So that worked out reasonably nicely. It actually worked out to plan, which is absolutely bizarre and unusual. So well done, Seneca. But back in the mainstream, in my SIP, I've immediately broken my own rules about the type of investments that I'm following by backing an individual stock bet, which was a company called DaVita. This is a US dialysis provider, and I was alerted to it by a discussion on share buybacks. Now, DaVita doesn't pay any dividends and just relentlessly buys back its shares all year. It's on a PE of about 10, and it uses all of its free cash flow to buy back its shares. So it historically has bought back between 7 and 15% of its shares each year. And on a PE of 10, it seems to me a sort of engine where it's just going to eat up the remaining outstanding shares. And something interesting could happen to the share price. 40% of it is owned by Berkshire Hathaway. They like that same story. Now, it's a bit risky. Their revenues are impacted by Medicare and Medicaid costs, and the rules there keep changing. It's not a growth business. It's very stable. but low growth business. So that's a bit of a sort of a one-off punt, and it's really not my usual wheelhouse, but I couldn't resist after having a quick look at the company. I've also been buying a company, Riverstone. They do lending to energy projects. Historically, it was oil and gas projects, increasingly to green energy. This is a UK investment trust. It's trading at about 15 to 20% discount to NAV. The managers don't like that discount and have begun a share buyback program. Meanwhile, it's yielding about 7 to 8%. So much more my normal sort of area of action. I've also got a little project where, if I can get the time, I want to start looking at UK REIT debt profiles. When I've been on the program previously, I've mentioned that quite a big part of my SIP is in REITs because there's a big tax advantage to getting the dividends within a REIT. But what I'm interested in is whether there are some REITs out there with very long-term fixed rate debt, because it just seems to me that if some of them, well, I know quite a few of them have got a debt fixed for sort of 5 to 6 years, but there appear to be a few which have debt fixed for 10 and 12 years. If they locked in those crazy low borrowing rates, 2.5% for 10 to 12 years, my goodness, their revenues, if the revenues float up roughly in line with inflation, they're going to be very well set. So that to me looks like a possibly interesting place to hide out.
Thanks, Stuart. On your time in the market, I think it all depends on what you do if there is a bear market. Because if you sit it through, then yes, I think that's sticking to the strategy. The trouble with why most people can't do that is that when the numbers turn really red, they get out. And so if you look at when UK retail investors tend to buy and sell, they tend to sell systematically when the markets are doing badly, and then buy back in when it's doing well. So they're kind of sadly highly cyclical, and they tend to lose money. So,
yep, you've got to know yourself, know your personality. I'm reasonably self-knowledgeable in that I know how I behaved during 08, 09 and other crises where if I'm confident that the underlying company I'm invested in does have turnover growth, does have dividend growth, or at least, obviously in those times, not so great operational performance, then I can sit with a lower share price. And I love the idea that if they keep throwing out the dividends, then I will use those dividends to reinvest at lower and lower share prices.
Yeah. Okay, so my performance over the last 2 weeks, I am down 1.1%. Reminder, so I now hold almost no equities, and I've got mainly in long-term bonds and US bonds in particular, having moved 95% of my assets into US dollars. And obviously there's been a bit of a bounce in risk appetite, and the dollar sold off, which was bad for me. So the all share was up 2% over that period. So I underperformed by 3%, but I am still having a good year. Now, actually, I did have one sell. I had a limit order to sell the remainder of my position in Shell at £22. And I'm very happy to report it very briefly ticked over £22. Closing the day well below that, and has since drifted off again. So, happy with that. And I've used the proceeds to buy more of the very long dated US Treasury bonds. So these are the longest dated US Treasuries you can buy. And 100% essentially of my foreign brokerage account is now held in very long dated US Treasuries. And I think inflation's coming down, but worse than that, I think there's going to be a terrible energy crisis and a flight to safety. And US is well placed to benefit from that. And frankly, given the politics going on in the UK and what I see a populist response to the energy crisis in the UK. Nobody cares about the value of sterling. Then I'd prefer to have my money in US dollars.
Keith, well, one small point about your trades in US Treasury bonds. I've never traded in them. Well, what's the bid offer spread like? Is it minuscule?
Minuscule, yeah, tiny. Very actually, when you look at the spread, I mean, the thing is, the spread compared to the volatility is really tiny. So you can it trades like a stock. So it's on exchange in a way that if you trade gilts, there's no exchange. You have to go through a broker. So I use Interactive Broker, and you can just put in a bid and wait to get filled. And your trade size compared to the size of the market is just absolutely minuscule, frankly. And you're trading for 1 or 2 basis points spread, so nothing.
Yeah. Yeah, so your round trip costs are nothing unless you have to pay some FX charge.
Yeah, and no matter how big your trade is, the commission's $5. So it's
Yeah.
essentially negligible. And my long dated UK gilt. Now, I bought it at 91. It collapsed to 75. And what I find really interesting is this week, the Bank of England talked about UK inflation rising to 13% and then persisting at 10% plus for the following year. And the 2050 gilt, its price actually rose. So, it's massively negative real yields currently, but you're not seeing any change in long-term interest rate expectations in the UK. And to me, a big sign that a market has bottomed is when it ceases to react to bad news. And to me, I'm increasingly confident in my trade in long-dated gilts. Obviously, it could still go terribly wrong. And on the Discord channel, there is quite a lot of skepticism about this trade. But this is essentially what I do, trying to time the cycle. And to me, this cycle is just about the most predictable I've ever seen. In Europe, there is just no doubt that we're going into recession. The question is how deep and how bad it's going to be. And I think we're going to go into a very bad recession in Europe, and there will be a flight to safety, and the safest assets will be treasury bonds and at some stage gold. But gold tends to sell off in the early stages of an equity market crash because investors need to liquidate their safe havens to pay their margin calls. They sell what they have to rather than what they want to. So at some stage, I will be buying gold, but not yet. Okay, thank you all for watching. Thank you to Stuart for filling in for Richard. I will be attempting to get something out next weekend, possibly on Friday night. In the meantime, thank you all for watching, and it's good night from Stuart Owen.
And good night from Keith Jordan.
Goodbye.
Good night.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.